traders, welcome back. Michael Harding here from the Academy of Financial Markets. In this lecture, I'll basically explain the difference between swing trading and day trading in terms of risk management. So there are different strategies to use depending on the time frames that you guys are also using. If you're one that tends to switch from multiple time frames, so right now we're looking at Aussie USD on a 5-minute. If you're the type that switches over to a 15, 1 hour, because you want to look at the bigger picture, right? So when putting in a stop loss and understanding risk management with day trading and swing trading, it's slightly different. It's a slightly different approach. In the last lecture, I was explaining how it's important to maintain a 3% risk management rule. That's for day trading. That rule should definitely apply as well for swing trading. It's just you have to be a little bit more crafty with your work when it comes to swing trading, and you have to have a different level of discipline because swing trading, if you're the type that always looks at the computer and you're always looking at your positions, it's a roller coaster ride. So sometimes you could be up quite a bit, and at other times you might be looking at your account and wondering or wishing that you closed the trade, and then holding on to it. So it's very easy for it to get on your emotional side. That's swing trading, and also like with stop losses and stuff like that, it's slightly different. Let's just take a look at Aussie USD on a daily, just to give you an example of what I mean here. So when Aussie came up and was rejected at around the 0.80 handle, so right around this level here, there was a strong rejection, and we can see that strong rejection with these wicks in these candles. So price action rose to these highs, was unable to hold on to those gains, and was completely rejected. Okay, so now thinking that this is a good level of rejection, if we are able to come back and test these levels again, this might be a good opportunity to go short, and it was a good opportunity to go short. Okay, it's just it all depends on where you put your stop loss. And this is with swing trading, day trading, guys. Okay. So if you were waiting patiently for this level to be tested, let's just say around the 80.30 or 80.32, so slightly lower than these highs here. So if you got in a little bit too early because you didn't exactly have the full patience to wait for this price to be tested, you got in a little too early, and then you put in your 30 pip risk, right? That would have been right about there. You would have been stopped out, and then the pair fell down. So when it comes to day trading, your risk needs to be a little bit more. Okay, sorry. When it comes to swing trading, your risk needs to be a little bit more. So if you're holding on to positions longer than a day, okay. Swing trading can last anywhere up to a few weeks. That's typical swing trading. So, you want to have a bigger risk allowance for your trades when looking at larger time frames. I would personally give it around 60 pips is probably your risk allowance that you would want to implement. So in that case, you wouldn't have been stopped out when, going at shorting this particular pair here. Okay, so day trading or intraday trading, 30 pip risk seems to be acceptable, and it seems to be working as long as you have enough patience. And then with with swing trading, you want to have a little bit more risk for each trade that you make. Okay, so that's basically the main difference between swing trading and day trading. I'm going to leave it there. Be sure to watch the next videos, guys. We're getting into the next chapter. A lot more exciting stuff up and coming.